Every value investors ask the same question in 2026. Is it a better to buy the cash cow, the market leader, or the secret manufacturer? Today, we are pitting three giants against each other: ITC, HUL, and Hindustan Foods. Before we look at the chart, we have to talk about value philosophy. I mean, the value investing. This isn't just about buying what is cheap, it's about the margin of safety. It's about like finding a business where intrinsic value, what company is actually worth, is far higher than the current sticker price on NSE. It's all about like whether we are paying the right amount to buy the particular stock or not. As a late Jan 2026, the FMGC sector is at the crossroads. Inflation is cooling, rural demands is finally picking up, and the gap between these three stocks has been never been wider. By end of this video, I am going to give you a 10 hard-hitting comparisons points that will show you exactly which of these belongs in 2026 as part of the value portfolio. I mean, the value investing portfolio. The first point is all about the valuation. I'm going to talk about the P ratio of ITC, HUL, and Hindustan Foods. ITC is trading at the deep discounts, which is something around 11.5. It is a Cinderella of the sector. And HUL, it is trading at the premium of 51 dot some number, and you are paying for Unilever as a brand safety. Hindustan Food, it sits at 42.0 or 2, reflecting a high growth expectation from this contract manufacturing. Point number two, it's all about the efficiency. We are going to talk about ROCE. ITC leading the pack with 36.6 percentage. HUL have a respectable 23.4 percentage, and Hindustan Foods lower at 14.3 percentage because they are in the heavy investing building phase. Point number three is the dividend. I mean dividend yield, the pay to wait factor. It's basically like what exactly you will get paid by the companies. ITC having a massive, which is 4.4 percentage, its income generator. HUL has 2.2 percentage stable but conservative, and Hindustan Food has 0 percentage. They reinvest every penny into the new factories. Point number four, the debts. ITC and HUL both are debt-free company. They are financially strength. And when we talk about Hindustan Food, they have the debt to equity around 0.6. They use the leverage to fuel their B2B expansion. Let's talk about the ownership. I mean, the point number five is all about the promoter. ITC has 0 percentage promoters. It is professionally managed institutions. HCL has 61.9 percentage, Unilever PLC, the strong global percentage. Hindustan Food has 61.3 percentage, higher promoter ownership, which value investors love. Point number six is FII and DII sentiment. ITC FII has around something like 36.6 percentage, and DII support they have around like 48.9 percentage from Indian banks and LIC. HUL, it's all about like FII have been trimming while DII stays stable. And when we talk about the Hindustan Foods, DII are piling in, rising to 14.6 percentage as a mid cap pick. How is the cash flow? So point number seven is all about like cash flow strength. ITC has a cash machine generating. They have around 17,600 crores from operations. And HUL, it's solid and stable, and they do have 11,800 crores. And Hindustan Foods cash flow is positive but tight due to the massive capex. Point number eight is all about like technical. So it is on we are in the value zone or not. ITC is completely oversold. Of RSI indexes around something they have 15. Technical indicators suggest it's a major bottom. HUL is consolidating above its 200 DMA, safe but no momentum. Hindustan Food, it's a weak short-term trend and currently testing support with 420. Number 9 is all about like business model resilience. ITC, it is completely diversified. Basically, they do have tobacco, hotels, and FMGC. I think hotel business has been moved to a different company called ITC Hotels. Cigarette business, it is acting as a moat for them. And when we talk about from HUL, it's a pure play FMGC. Totally, it is dependency on the consumer sentiment. And when we talk about Hindustan Food, it's a B2B product. They don't care which brand wins as long as people buy soap, they make money. Now we are at the last point. It's all about like revenue growth, the 2026 outlook. Hindustan Food is the winner here with 53% year on year the profit growth, and ITC and HUL they have a mature growth which is something like 8 to 12% range. Being as a value investor, I choose ITC. ITC is one of the most significant stock and it is completely trading low, and the book value is also quite reasonable, and moreover it has the good PE value. When we compare with the industry PE, it is very less. I feel like the stock is completely discounted now. It's a good time to invest heavily. There are certain reasons why ITC wins heavily on this particular bet. The deep value valuation gap. While HUL sits at the rich 51.2 PE, ITC has plummeted to 11.5 PE. Even with the new 2026 tax hikes, the earning power of its FMGC and agribusiness make this particular valuation looks more like a steel or commodity company than FMGC's giant it actually is. The oversold technical trap. ITC RSI is currently at 13.7 and one of the lowest in 20 years. Technically, it is a strongly oversold. Historically, the data shows that when ITC RSI drops below 20, a relief rally or massive U-shaped recovery is just around the corner. Here, the dividend is acting as a safety net. If you invest heavily, you want to be paid to wait. ITC dividend yield is now north of 4.4%. Even if the stock price stay flat for a year, you are betting most saving accounts just on payouts. Pricing power versus tax hikes. Feb 1st, excessive hikes, I mean the basically like the tax hike, the physical bombshell, you can call whatever it is, but ITC has 70% of market share. The history proves that ITC successfully pass on tax hikes to consume through the calibrated price increases. The volume dips initially, but the stickiness of the brand brings them back. FMGC margin expansion. This is actually the hidden story. While everyone watches cigarettes, ITC FMGC segment is hitting 10% EBITDA margin, and the brand like Ashirwad, Sunfeast are now the primary growth drivers regarding of tobacco taxes. Institutional support like DII versus FII. Despite of FII are selling, the domestic mutual funds holds nearly 195 crore shares. Indian institutions are using this tax crash to accumulate. When the big money in India is buying, you have a flow. Cash flows, debt-free shield, unlike Hindustan Food, which has 0.6 debt to equity ratio. ITC is a debt-free with 17,000 crores in operating cash flow. They can weather a temporary volume drop without breaking a sweat. Hotel demerger clarity. In 2025, the demerger is over. I mean, the clutter is gone. Investors now have a clear path to valuing the FMGC and tobacco business as a separate and high performance engine. Management's of ITC next strategy, they focus on digital first brands, Yoga Bar, Mother Sparsh, and all those stuff, has reached 1100 crores run rate. This isn't your grandfather's cigarette company anymore. It's a tech-enabled consuming powerhouse. How I'm going to invest on this particular stock? I'm investing heavily, that's being sure, but I'm not buying all at the once. My strategy is simple: 30% now, capitalizing on the RSIs being under 20, 40% after Jan 29th, waiting for Q3 earnings commentary on the tax hike, and 30% on trend reversal when the stock crosses 345 at the resistance level. The price is what you pay, the value is what you get. Right now, the price of ITC is being dictated by the fear, and that is exactly when the value investor move in. You might have liked this particular video. If you like this video, please do hit the like button and do subscribe my channel to get all this kind of informative content. Thank you so much and happy investing.